Section 3-2 Introduction to Alpha, 3.2 Active Management and Passive Investing. Assessing the benefits and drawbacks of active management and passive investing involves understanding the characteristics and considerations associated with each approach. Here's an overview of the benefits and drawbacks of active management and passive investing. Active management, benefits, potential for outperformance. Active managers aim to outperform the market or a specific benchmark by leveraging their investment expertise, research capabilities, and active decision-making. Skilled active managers may be able to identify mispriced securities or take advantage of market inefficiencies to generate excess returns. Flexibility and adaptability. Active managers have the flexibility to adjust their portfolios based on changing market conditions, economic outlooks, or individual security analysis. They can take advantage of market opportunities or reduce exposure to potential risks. Customization and personalization. Active management allows for customization and tailoring of investment strategies to specific investor objectives, risk tolerances, and preferences. Active managers can actively manage portfolio allocations, sector weights, and security selection to align with individual needs. Drawbacks, higher fees. Active management typically involves higher fees compared to passive investing. Active managers incur costs for research, analysis, trading, and ongoing portfolio management, which can erode returns over time. Potential for underperformance. While active managers aim to outperform, there is no guarantee of success. Many active managers fail to consistently outperform their benchmarks over the long term. The pursuit of alpha through active management carries the risk of underperformance, which can be attributed to various factors such as wrong investment decisions, high trading costs, or market inefficiencies. Manager risk. Active management introduces the risk that the portfolio manager's investment decisions and strategy may not deliver the desired results. Manager skill, consistency, and the potential for key personnel changes within an active management team are important considerations. Passive investing, benefits, lower fees. Passive investing typically involves lower fees compared to active management. Passive funds aim to replicate the performance of a specific market index or benchmark, resulting in lower management fees and trading costs. Broad market exposure. Passive investing provides broad exposure to the market or a specific index, allowing investors to capture the overall market performance. It offers a simple and efficient way to gain diversified exposure across various asset classes and market segments. Transparency. Passive investments are typically transparent, as they aim to replicate the performance of an index. Investors know what securities are held within the portfolio and can easily understand the investment strategy. Drawbacks, lack of active decision-making. Passive investing does not involve active decision-making to select individual securities or time the market. As a result, passive investors cannot take advantage of potential opportunities for outperformance or adjust the portfolio in response to changing market conditions. Limited ability to deviate from the benchmark. Passive investing aims to closely track the performance of a specific index. This means that passive investors are inherently exposed to the risks and performance of the underlying index. With limited ability to deviate from its composition, inability to outperform the benchmark, by design, passive investing seeks to match the performance of the benchmark, rather than outperform it. This means that passive investors are unlikely to generate excess returns beyond the market or index performance. It's important to note that the choice between active management and passive investing depends on individual preferences, investment goals, risk tolerance, and the specific market environment. Some investors may prefer active management to potentially seek outperformance, while others may prefer the lower costs and simplicity of passive investing. Combining both approaches through a blended or hybrid strategy is also an option to consider. Alpha plays a significant role in evaluating active managers' ability to generate excess returns beyond a benchmark. Here's how alpha is used in assessing the performance of active managers. Measurement of outperformance. Alpha is a measure of an investment's or portfolio's excess return relative to a benchmark after adjusting for risk. It quantifies the added value generated by active management decisions or strategies. Positive alpha indicates outperformance, suggesting that the active manager has successfully generated returns beyond what would be expected based on the level of risk taken. Evaluation of skill. Alpha is used to assess the skill and effectiveness of active managers in making investment decisions. A positive and consistent alpha over a meaningful time period suggests that the manager has the ability to identify mispriced securities, exploit market inefficiencies, or make successful tactical asset allocation decisions. It indicates a manager's ability to add value through active management. Differentiation from passive strategies. Alpha is crucial in distinguishing active managers from passive strategies. Since passive strategies aim to replicate the performance of a benchmark, they do not generate positive alpha. If an active manager consistently generates positive alpha, it suggests that their investment decisions and strategies have the potential to outperform the benchmark. Providing a compelling reason to consider active management over passive investing. Risk-adjusted performance. Alpha can be considered in the context of risk-adjusted performance. Risk-adjusted measures such as the Sharpe ratio or information ratio help assess the excess returns generated per unit of risk or active risk. Positive alpha combined with a favorable risk-adjusted performance indicates that the active manager has generated excess returns efficiently and effectively managed risk. Comparison among active managers. Alpha allows for comparisons among different active managers. Investors can assess which managers consistently generate higher alpha, indicating a greater ability to generate excess returns. However, it's important to consider factors such as investment style, risk management practices, and the specific market conditions during the evaluation period when making comparisons. It's important to note that alpha should not be the sole determinant of evaluating active managers' abilities. Other factors such as consistency of alpha generation, investment philosophy, process, risk management practices, and qualitative aspects like the manager's expertise and experience should also be considered. Additionally, alpha should be evaluated over a sufficient time period to account for market cycles and potential short-term fluctuations.